Hi guys, so we're going to talk a little bit more about the history of consumer debt from the 1930s to the 1950s, the Great Depression. That's where home mortgages were born, and we're going to talk about the two kinds. In 1933, the United States housing market was collapsing, obviously because of the Great Depression. To avoid complete disaster, the government created the Federal Housing Administration, commonly known as the FHA, as part of its New Deal. The FHA had one goal: to create jobs and stimulate the demanding of building materials. FHA created two programs, Title I loans and Title II mortgages. The government decided not to offer homeowners direct assistance. Why? I don't know, don't ask me. Instead, the government would insure bank-issued home loans. So if the homeowner defaulted, the bank would always get the principal back. Title I and Title II mortgages, we're going to talk a little bit about those. So in the 1930s, a lot of the homes didn't have electricity. So if you had a home like that, you could apply for a Title I loan to modernize it. So what you would do is you'd go to your local bank and apply for the Title I loan. You would select a repayment of either 1 month or up to 5 years. The interest on your loan would be less than any installment loan that you would get on a credit contract for a durable good like a refrigerator or a microwave or furniture and stuff like that. And now that your home has been wired with electricity, you can now buy that durable good. Radio, air conditioner, automatic garage door opener, woo, super fancy. So let's say, for example, now you don't have a home, but you want a home. You can apply for a Title II mortgage to buy an FHA insured house. Again, the fact that FHA insured the bank and said, hey, you lend to them, I will make sure you get your money. That's all that means. So what the person would do is they'd go to the local bank and apply for a Title II mortgage. The mortgage would be maybe 15 years. So prior to the 1930s, mortgages lasted an average of 3 to 5 years, really short amount of time. Houses used to be considered short-term debts, but obviously that no longer is the case. Now they're good long-term investments, anywhere from 15 to 30, even 45-year loans they have now. So once you got your Title II mortgage, you can enjoy your home in a new neighborhood, most likely in the suburbs. The consequences of FHA programs were that Title I loans meant that Americans could cheaply and easily improve their living conditions, and Title II mortgages introduced the country into suburban living, right? Mortgages inadvertently created the suburbs. FHA created an underwriting manual to help banks identify properties that met its good housing rating. So if you bought a well-rated home, it was likely you'd qualify for cheap and government-issued mortgages. There's a lot of problems with that. But anyway, we can get into the history of mortgages and stuff like that and redlining and all that in another video if that's something you guys want to talk about. But for right now, we'll just stay on topic. Suburban homes were easily rated. They could be built to meet new housing codes. If they were built to look alike, then they were believed to be stable. For these reasons, banks also saw that suburban homes having a greater value than urban areas because they all looked uniform and looked pretty. The success of the two FHA programs gave banks the confidence to expand into personal lending. If you took out a personal loan with the bank, your address and stable future salary would be used as collateral instead of your assets. Banks entered the consumer lending space, gave rise to credit reports. So credit reports is relatively new, guys. And 24/7 banking. Ads reminded consumers that taking out a loan means establishing credit. Once your credit's been established, it's easier to borrow again. Sound familiar? Still doing it. Consumer lending and suburban mortgages clearly favored those who were middle class and salaried. If you were poor and working class, whether you're white, African American, or any other race, or unmarried woman, you wouldn't have been able to access these benefits of credit. So let's talk about the 1940s and 1950s. During the Second World War, government tried to contain inflation by regulating installment credit. With less credit for consumers, sales fell hard, obviously, because people couldn't afford it. This motivated retailers to create a hybrid credit. They weren't regulating these hybrid credits. So this was the first step towards revolving credit. This hybrid credit plan went a little something like this. So suppose that you went to go buy some clothes. Instead of paying it in installments at the end of each month, the store clerk would help you open a charge account. Your purchase would be recorded in the books and you'd repay it over time. You might ask, what if I paid my purchase slowly? Minimum payments, or very little at a time? Well, that'll be up to you. You're being charged interest on the balance. Sound familiar? That's what we do now, right? So that's the birth of revolving credit. New technologies help retailers manage these hybrid credit accounts with a charge a pay or an addressograph, which is essentially like what started like direct mail and junk mail and stuff like that. It was just kind of like a little plate that helped them be able to make a lot of addresses really easily. And it made it easy to identify customers and their addresses. So bookkeeping was very simplified and made it easier for people to freeze their accounts, and it helped retailers to comply with installment credit regulations. And added together the revolving credit, it made everything more formal. So the use of revolving credit continued after World War I. And even after installments, did I say World War I? I meant World War II. Even after installment credit regulations were removed. The government tried to regulate revolving credit during the Korean War, but it didn't work out too well. However, that only made it more popular. By the end of the Korean War in 1953, revolving credit plans and the inventions like charge-a-plate made consumer business a central aspect of the American finance world. Revolving credit completely altered the shopping experience, and poorer customers became indistinguishable from wealthy customers. Once reserved for the wealthy, now anyone can say, charge it. That's the end of this video. Wait until the next one. See ya.